You are told your raise reflects your performance, that the harder you work, the more you earn. It's the foundation every corporate merit system in America is built on, and it's a complete fiction. Your raise isn't calculated from what you accomplished this year. It's calculated from a budget pool your company decided back in January before the performance year even started. The review, the rating, the feedback about opportunities for growth, all of it is stage dressing designed to make a predetermined number feel earned. The worst part isn't that the system is rigged, it's how easy it is to prove. Every American worker learns the same story from their first paycheck. Work hard, get noticed, get rewarded. Your performance review is the stage where this plays out. You prepare for weeks. You document your wins. You rehearse how you'll talk about the project that saved the company 300 grand, or the deadline you hit that nobody else could. Your boss sits across from you in a conference room and calls your work exceptional. He uses the word twice. Then he slides a number across the table. 3%. You check with coworkers over lunch the next day. The person who barely shows up got 3%. Employee of the year got the same. The guy who sleeps at his desk got 3. You delivered 3 major projects ahead of schedule, and somehow you landed on the identical number. Somewhere between the speech about exceptional performance and the actual figure, the meritocracy quietly disappeared. But you say thank you, because what else are you going to say? You walk back to your desk. Your rent went up 7% this year. Your health insurance premiums went up 12. Your actual spending power is lower than it was last year, and you just thanked someone for that. This is the version almost every American participates in, and almost nobody questions it because the theater is convincing. The first thing that breaks the story is the calendar. Your performance review happens in December, but your raise was decided in January, 11 months before you did any of the work you're being evaluated on. In a conference room somewhere in the executive wing, the CFO pulls up a spreadsheet showing total payroll for the year and multiplies it by 3%. That's the merit pool, finalized in under a minute. The number exists before the fiscal year even starts. Every email you'll send, every deadline you'll hit, every late night you'll pull, all of it happens after the pot has already been measured out. You'd think someone would have said something. Nobody did. From there, the pool gets divided across every employee in the company. Some people will get 2%. Some will get 4. Most will get 3. The average has to come out to 3 because the budget says 3. That constraint is mathematical, and it doesn't bend for your project or your saved accounts or the coworker who told your boss you were exceptional. So when your manager says the company can't afford more than 3, he's not making that up. The pool is the pool. But its purpose was never to reward your contribution. The pool exists to keep total compensation costs predictable for shareholders so quarterly forecasts don't wobble. Your performance is just the input that gets fitted to a number already decided. This decision seemed small at the time. It wasn't. The January meeting is where every corporate merit raise in America is actually decided, and the rest of the year exists to make the number feel personal. If that were the only problem, the system might still function. But then comes the forced distribution curve. Your company has a rule, usually called a merit matrix or a rating calibration, where only 10% of employees can be rated, exceeds expectations. 70% have to land in meets, and 20% have to be below. Now look at your team. 8 people. 10% of 8 is 0.8. You can't have 0.8 of a person in a rating bucket, so the system rounds down. Nobody on your team of 8 can be rated exceeds expectations. Your exact same work on a team of 15 would land you in the top bucket, but on a team of 8, you get meets expectations, which equals 3%. If you're wondering how that's even legal, so is everyone else. The rating had nothing to do with your performance. It existed to make the budget math add up. And this next part is the one that even the defenders of the system can't explain. The 3% pool doesn't apply to everyone. Executive compensation is a separate line item with a different category and different rules. While your raise is capped by the merit matrix, senior executives get stock options that appreciate with the market, performance bonuses tied to revenue, retention equity that refreshes annually, and long-term incentive plans that vest in tranches. None of it runs through the merit pool. Data from groups like the Economic Policy Institute has tracked executive pay at large public companies growing many times faster than typical worker pay, with most of the gains coming from stock and performance components that aren't subject to merit calibrations at all. Your boss can accurately tell you the company can't afford more than 3% for you because the budget constraint is real. What he won't tell you is that his own package lives in a different spreadsheet entirely. That's the kind of detail that makes the meritocracy story fall apart. The ceiling you keep hitting belongs to your job class, not the company. Executive packages live above it. The data that leaked next made everything worse. It came from a pattern every HR department knows and almost no employee sees. The person hired to the seat next to yours last month makes more than you do, sometimes significantly more. The reason sits inside your own offer letter. You were hired 6 years ago at the market rate for your role at that time. Every year since, you got 3%. The new hire was brought in at today's market rate, and market rates for most professional roles have been rising faster than 3% a year. So every year, you stay in the same job, you fall further behind the market. Picture two lines on a graph. One is your salary, climbing at 3%. The other is market rate, climbing faster. The gap between those lines widens every December. Career research on voluntary job changes in professional roles suggests the average pay jump per move lands somewhere in the mid-teens to low 20s, depending on the field and the year. Run the math on a coworker who changed jobs twice in 4 years versus someone who stayed and compounded at 3, and the gap can easily stretch past 30%. You stayed. The loyalty penalty is measurable. It shows up as a specific number on a specific spreadsheet, and you can calculate yours in about 10 minutes. So, if the system is rigged against staying, the obvious move is to leave. And if you get far enough to bring back a competing offer in writing, something strange happens. The budget constraints disappear. Suddenly, your company can afford $15,000 more. The 3% ceiling they quoted last month was never real. It was just the price they thought they could get away with. But if you accept the counteroffer, you're now marked. Inside the company, your manager starts looking for a cheaper replacement who won't threaten to leave. You might be offered a retention bonus paid over 2 years with a clawback if you exit early, handcuffs wrapped in appreciation paper. Most employees who accept counteroffers end up leaving within 2 years anyway, often pushed rather than pulled. The real play is the one almost nobody runs, because it requires doing the uncomfortable thing first. Find out what your role actually pays on the open market. Not what your manager says, not what your HR portal shows, the actual offers being made to people with your skills right now. Bring that information back only after you have a real alternative in writing. You don't need to bluff. You just need to know the number the company already knows and is counting on you not to. The entire system runs on one thing, and you can picture it as a table with 4 chairs. Your manager sits in one chair and knows market rate. The HR business partner sits in the next and knows the merit pool. The CFO holds the executive carve-out. The one person at the table without any of that information is you. So that 3% raise this year came from a decision made last January, before any of your work existed. The review was theater. The rating was arithmetic. The only question worth asking now is how much you've been leaving on the table every year you didn't check. If this broke the illusion, please leave a like on the video and hit that subscribe button.